Good morning, ARMR Insiders, and everyone. Welcome to the live morning meeting on Wednesdays, open for all. So don't forget to share, like, whatever, bring your friends in. Let's make this a lively conversation. This is a virtual hedge fund. We're managing our own private capital, managing capital for others, sharing that information with our subscribers, making a virtual hedge fund. You guys that are on the desk with me all day, and anybody joining right now for our morning meeting, you got to think like a portfolio manager on a hedge fund desk. We're going to look at managing risk right now. We're going to look at focus areas of the market where we may be taking investments. We'll call those top stocks to watch. And before I get to all that, I ask you right now, grab your pen, piece of paper, get ready, but remember, you have to execute your own strategy. What's your risk tolerance? What are your goals? All that kind of stuff. Make your own decisions and be the smart money. All right. We're going to get to a focus today on rare earth element stocks. They have to rocket to the top of our whiteboard, and we'll talk about why in a second. I'm going to go over our macro fund, our risk monitor. We're going to discuss and kind of break down a bit all the different algorithms we use, proprietary, that give us the shades red, yellow, or green, and what has to happen to get to that next color change. And then I'm just going to go over some of the key pieces of news today that I think really matter. So let's dive in. Let's start with the macro picture, and that's going to be here, this algorithm right here. All right, so this is the S&P. Now, you guys know that the risk monitor went red a few weeks ago. And let me just break it down for you real quick on what the risk monitor is, just for all of you to understand the information that I'm sharing with you. These are proprietary algorithms that put us on the right side of probability when reward is worth risk. If we do that over and over again, probabilities work in our favor, and we're going to have serious alpha. The object is to avoid debilitating drawdowns in a portfolio and then capture upside when the probabilities are dramatically in our favor. We know it's still a probability algorithm. Sometimes we'll get long, market will break down, we have to get back to cash. That happens. There are no guarantees in this market. What you have to do is, when you see a drawdown in your portfolio, it has to be one where you're on the right side of probabilities and there's a draw. That's okay. It's when you give away cash in a market that's totally against you that's a killer. That's what's a killer. There's nothing wrong with risk monitor green or whatever your strategies are, but ours is risk monitor green, and getting long and getting stopped out. That's, rubbin's racing. That's part of the game. The part of the drawdown you have to stop, you have to avoid, is the drawdowns for no reason, where you're fighting the market. 8 out of 10 stocks follow the market. You don't want to be that salmon trying to swim upstream, because, proverbially there's that bear that's going to grab you and eat you. It's just not worth it. So today, what I would say to you is, we went risk monitor green a couple weeks ago. We're a stone's throw on this desk. We're a stone's throw away from new highs on the year in our net worth. So we've avoided the drawdown in the markets right now. We're in a maximum cash position. We're long precious metals, physical, and utility stocks. That's as defensive as we're going to get. What I wanted to share with you is what I employ are layered algorithms, right? So I've written algorithms for 10 indexes. We kind of dial it in. The engine's the same for the algo, and we dial it in based on volatility of different asset classes, from Bitcoin to treasury bonds, small caps to big caps, mid caps, everything, right? And that's what the 10 indexes are that drive our risk decision. But we have layered algorithms of different time frames and different stop strategies. And so what I'm saying to you today is, yeah, the risk monitor went red 2 weeks ago. There's been a drawdown. And what happened yesterday is the final piece to the puzzle. I try to make it simple. I try to relay the information to you in a simple way. And I say the risk monitor is red, yellow, or green. Red, max cash. Yellow, we can put some money to work with caution. Green, we get aggressive and put a lot of money to work, okay? But if I were to drill down now and use different shades of those colors, I would say to you, we are blood red right now. It's as red as it can get, because this algo right here is the primary driver of everything we do. The algorithm for the S&P, SPY weighted index is our best algorithm based on percentages. It's the highest probability of success. And this particular time frame I'm sharing with you, the 60-minute, incorporates the most lenient stop strategy, which makes sense because the market goes up most of the time. And when I'm dialing in, optimizing algos, I can tell you right now that the profitability of the algo goes up the more lenient your stop. If you're allowing for more volatility, generally the market's going higher, and so your performance goes up, right? So you have to marry risk management and drawdown with profitability. And this is our gold standard. This is the best algo we have in that regard. And that algo finally exited the risk monitor green entry point from April 23rd, okay? We put on positions April 23rd, caught more or less the bottom in the market, and we've had a huge run. That algo, our highest probability algo with the most lenient stop, finally was taken out yesterday. And that shifts us to as negative as we can be. Now, we're already in max cash, so there's nothing new for us to do. But I wanted to share with you that that loop has been closed now from April 23rd to yesterday, November, 17th? 18th, November 18th, okay? What does that mean going forward? Well, first of all, like I said, there's nothing for us to do. We're already in max cash. We preempted that because we use other algos and other indexes that lead risk. And so we could see this coming and we didn't have to wait for this. So we already raised cash. That's the whole point of the 10 indexes we use and the different algorithms we use, okay? And the different time frames. So what I would say about this closing of the loop now, on the one hand, that had to happen. If the market's about to really get hammered, that was the last straw. So on the one hand, it's as bearish as we're going to get. On the other hand, I'd say to you that when the risk monitor goes this red, I start to get, quite frankly, excited, because that's what we need to clear the decks and get ready for the next risk monitor green, wherever that shows up. We might be buying the market cheaper. We might be buying things a lot lower. Hey, we might pay up for things from this level. The risk monitor green could be a couple weeks from now, market's breaking out and putting money to work. And that's great. Today was the low. This could be the low. NVDA announces earnings tonight. Let's take a look at NVIDIA. We'll get to rare earths in a minute. There's NVIDIA. Okay? It's hanging in the balance. Depending on the reaction to NVIDIA's earnings tonight, we could have acceleration lower. Probabilities would favor an acceleration lower. Risk monitor's red. It's as red as it's ever going to get. The S&P, and by the way, and the NASDAQ. So QQQ and SPY both got stopped out yesterday from the April entry point. So it's as dangerous as it can be right now. The hateful eight are still trying to hold the market up from real destruction. This is Atlas right here. And the question is Atlas going to shrug? I don't know. We'll have to read and react. And so I just wanted to say to you, the decks are clear. If everything's great over the next couple of weeks, we can get a risk monitor green. We'll put money to work. Market will rally into the end of the year. That would make tons of sense. Usually does that. It's very rare for the market to be doing what it's doing in November. There's only been 3 times where the market was down more than, let's say, 6% in history in November. The only problem with those 3 times is it's really ugly. 1929, 1987, 2008. So either the market's about to stop going down right now and rally to the end of the month, or things are going to get biblical on the downside. I don't know what's going on, to be honest with you. So we're risk monitor red, we're in cash, and we're waiting. We're just going to read and react to what the market tells us. It's going to tell us a lot tonight based on the reaction to NVIDIA's earnings. I don't care if they beat on all that kind of stuff. It's a question of what do they say about the future. And this is the Achilles heel that I'll be listening for on the analyst question and answer segment of the earnings. I don't care what the company's going to announce. Stock will go like this, could be up 10%, could be down 10%, whatever. The analyst questions will be the most important. This is what I want to listen for. We have a serious bottleneck in memory. SanDisk, Micron. We booked our profits right now. We're out of SanDisk and Micron. I can't wait to buy them back. When stocks have an uptrend that are this aggressive, they generally will consolidate, and the first test of the 50-day moving average is buyable. That's where I want to put money to work. It'll either be because the stocks go sideways for a series of weeks, which brings the 50 up to them, and then they blow out again. That'll be a high tight pennant. That'll be beautiful. Or they'll come down aggressively and touch the 50 and put in a reversal, and I'll be buying the 50. But I digress. What I'm listening for on the call tonight, is there any comment from NVIDIA that business is constrained because they can't get the memory? So all of the expectations of earnings and revenue in 2026, which is priced to perfection right now, is it going to have to come down because they just can't deliver? More and more and more deals are announced of more and more and more data centers. And I think that's great. We all think that's great. We all know it's great. But if those data centers can't be built in 26 and 27, and they have to end up being built in 28 and 29 because nobody can get memory chips, there's going to be a serious slowdown in the excitement of the build out in AI. That's the Achilles heel of the story. Makes me want to own SanDisk and Micron again, because I think next year is going to be a big year for these stocks again. But this is why you're seeing data center stocks sell off right now. And tonight, if that's the focus of the Q&A session with analysts, then we know we've got a problem in the AI space, and probably more air comes out and the risk monitor red continues, and November is an ugly month. So we'll see. All right, let's move on. Risk monitor red. We'll see what happens. We'll read and react. Let's don't get too afraid of that. Okay. If we see a risk monitor opportunity, we'll put money to work. Now, I wanted to jump real quick, if you'll allow me to, into a discussion last week. Every Wednesday, I like to go over the ARMR investing way and different parts to our strategy that make us successful. And what I talked about last week was 10x investments. How do you find them fundamentally? Stocks that 10x, how do you do it? And we went over the 3 M's that I use from a fundamental point of view: moat, management, margins. And I just wanted to touch on that again real quick. What does it actually mean? I went over chart patterns like Palantir, okay, and NVDA and SanDisk. These are stocks that explode higher. And we talked about how in every case, moat, management, and margins were all ideal, and that drove prices higher. That's what brings institutions into an investment. And what I wanted to say to you is if we broaden that out and we look at things like Microsoft in the 1980s, 90s, Facebook, Meta, when it first really started to take off in 2001, 2002, Illumina, one of our favorite and best investments. Dad and I rode that investment from like $1.50 on a split adjusted basis to 500. Okay. How do you make that kind of money? Why did we do that in Illumina? I just wanted to explain it a little bit more. Okay. Moat, management, and margins. Those three fundamental pieces have to be present for that type of move in a portfolio. And so what we want to do is build a whiteboard of companies that we think can 10x, or like, what's the point of what we're doing? Okay. We want, if you're going to make investments, there's risk on anything you do. So you want to make investments where the reward is worth the risk. Okay. So what does moat mean? It means that the company dominates a niche. Yes, there's competition, but the competition's so far behind, they're just nipping at the heels and they can't catch up. That's what a moat is. It's a business model. Palantir. There's other guys trying to do it, but let's be honest. Nobody does what Palantir does. Stock goes from 20 to 200. Nobody did what Microsoft was doing in the late 1980s. There was Apple and Microsoft fighting it out. Both stocks did well, but Microsoft did a lot better. Don't forget, Apple cratered before it reversed. And we're going to get to that in a minute because that has to do with management. Moat, management, margins. Nobody does what NVIDIA does. Stock's gone to the moon. Yeah, there's other guys that make chips. Yeah, there's other guys that compete, but they can't catch up. Facebook. Anybody remember MySpace, right? There's always somebody trying to compete and they can't even come close. Company comes public, sets up a perfect entry point, blows out earnings and revenue, 20% gap up in Meta. This was when it was Facebook, and back in 2002, I think it was. And the stock never looked back. Same exact chart pattern as Palantir. So you're looking to identify, when you're building your whiteboard, businesses where they've got a lock, a moat on, in many cases, a new technology, and it'll take years for anyone to catch up. That's the moat you're looking for. Then let's talk about management, because this is incredibly important. You either want the visionary, somebody visionary, Elon Musk, right? You could go Tesla. Tesla obviously created a market in EVs that just wasn't there before Tesla. There was just, and there's competition and they just can't keep up, right? The stock went to the moon. You had a visionary. But very often for me, what's most important when it comes to management is a proven track record. So let's talk about Google, for instance. One of the things that made Google such a huge stock is that the visionary founders, a company came public, stock went up, kind of went down, kind of struggled a little bit, and the visionary founders understood they needed a guy running their company who had a proven track record of success, and that was Eric Schmidt. When Eric Schmidt came in as CEO, that was the beginning of a massive move in the stock. And the reason is institutions had made a lot of money with Eric Schmidt over the prior decade in different technology, software, business turnarounds. In fact, I made a lot of money with him in a company called Novell. This goes way back. Okay. So it's a proven CEO that brings with him institutional investors who love what he does. comes into a company that has a moat of a business model, and the management can make it sing. That's one of the best, one of the most important things I look for when it comes to management is past success. And then, of course, we have margins. Illumina is like the margin story. Dad and I were working on Illumina for a couple of years, probably 3 years. Stock didn't really go anywhere. It was a new company. They were selling machines into the marketplace that would read human genomes and help drug companies come up with targets. This was right when the human genome was mapped. So there's a human genome mapping project, and then the first real product, a total moat around the business because nobody was doing it. And it took like 3 years of Illumina selling. If you want to understand what they did, their business model was like a Gillette business model or a Xerox business model, right? They were selling the razor. They were selling the Xerox copier into all of the research and drug company laboratories they could. And that was great. Razors and Xerox copiers might carry a margin of 50% if you're lucky. But what really ramped the stock to the moon is when they had enough of those razors and copiers in the marketplace, and the consumable business exploded. Selling razor blades, selling ink. Okay, that's which, by the way, consumables carry margins of like 95%. So all of a sudden, the margin of the business went from 50 to like 95%, and the stock went berserk. Moat, management, margins. Institutions love investing in companies where margins are ramping. So when you're building your whiteboard now, which is something you should be focused on because we're Risk Monitor Red and we're taking a break here on investing, so we're getting ready for the next cycle, order your whiteboard, put at the very top of the top shelf companies that have a moat around the business with great management and phenomenal margins that are expanding. That's where you want to focus your risk because the reward will be the greatest. Now let's switch over to highlighted group of the day that I think demands our attention. And we're going to use MP as the example of it. Okay? Who out there, show of hands, who out there thinks that because Trump and China came up with some agreement on rare earths that the story's over? Who is it? There better be no hands out there up. I mean, here's what happened in the rare earth story. And here's what I think is going to happen. Okay? We know we need to produce dramatically more rare earths in this country. By the way, they're not rare. They should call them something else. People call them rare earth, make it sound like it's rare. It's not rare. You just have to make an effort to find it and refine it. And China's the country that's done it for decades. And everyone just said, okay, we'll buy China's because they've already done it. Now we know we have a problem with that. And so we're starting to ramp up rare earth production in this country, which will take months and years to get where we have to go. So the first explosive move higher on these stocks, and MP is the poster boy, the centerfold of that move, okay? That first explosion higher is the recognition from investors. Oh my gosh, we're gonna see a lot of money come into this space. And we want to be there. So there's like an explosive move higher. And what did all of these companies do? MP, Quad Use, Ramco Resources, they all used the explosive move in the price of their stock to raise capital, which dilutes shareholders, right, in the short term, to raise capital so that they could take those proven and probable reserves and turn them into production. It takes time and it takes capital. So we had the first move higher, which allowed these companies to raise cash, which in the short term puts pressure on the stocks as they're diluting shareholders. And then we're going to get stage 3. So stage 1 was the blowout of recognition. We need this industry. Stage 2 is the sell-off, digesting the blowout and raising capital. And stage 3 is the real move that's sustainable over time. If you're a wave theorist, Elliott wave theorist, okay? Wave 3 is the biggest. That's ahead of us. Now, I want you to know I was writing this captain's note this morning, and then I saw a news story hit the tape that MP just cut a massive refining deal with Saudi Arabia. On top of that, Goldman Sachs just upgraded the stock to a buy, put a $77 price target on it. My price target on MP would be at least 130. So at some point in here, I don't know if it's going to be today. MP was up 9% a minute ago. It's up under 6% now. I'm not guessing. I'm just telling you, I'm ordering my whiteboard. If the risk monitor stays red, I will put to work in a portfolio stocks that don't follow the risk monitor. The risk monitor, stocks that are highly correlated to the risk monitor are innovative growth stocks. Commodities can trade opposite the risk monitor in certain markets. Anybody remember 2022? For 6 months, oil stocks went through the roof. Risk monitor was red, the market was going down. Okay, so we could get in that environment. So at the top of my whiteboard are rare earth stocks. At the top of my whiteboard are precious metal stocks. You know, silver and gold are in backwardation now between COMEX and London Exchange. You can buy in COMEX, take delivery, and sell on London Exchange for more. It doesn't make sense what's going on in the metals. But it does make sense. We've got a shortage, and metal prices are probably going a lot higher. It does make sense. So metals and materials are something you might find in my portfolio, even though the risk monitor is red. And rare earths at the top of that. So I'm just waiting for algo buy triggers close to key moving averages. And I think MP is a really good looking chart pattern right here. It's come right down to the 200-day moving average, spike up, pull back. It'll be up today, perhaps. Like I said, it's up about 6% right now. And that may give us a risk on entry point. I'll have to look at the algo at the end of the day. I'll let you know. Okay. Quad U's are on my list as they come down. METC is going through a complete unwind. METCB is the rare earth part, which you can see is doing a little bit better and above the 200-day. So we might just want the rare earth part. I still have my eye on BTU. Coal and BTU is another rare earth play with coal, and that's setting up real nice. So those are at the top of my whiteboard. A couple other thoughts for you before the bell rings, if I get time for it. One more thought I'm going to share with you. Let's say, all right, let's go with a couple of things, random things. Risk monitor is red, and Bank of America is telling us that cash levels right now at 3.7%. It's one of the lowest cash levels we've seen since 2002. That's very bearish. Okay, a lot of cash can be raised in here. Hey, Bitcoin, IBIT in a major downtrend. We've had options flip on their head. For the longest time, calls were dominating Bitcoin, and the 140 price point for Bitcoin calls was the largest open interest. That's flipped on its head. 85,000 is now the largest open interest, with a lot of open interest at 80 and 90, totally eclipsing the 140. So it's flipped on its head. On the one hand, eventually that's going to be firepower on the upside for Bitcoin. Whenever this stops going down, those puts are going to get dumped, and the thing's going to go through the roof. But until then, it keeps pressuring the price of Bitcoin lower, and I wouldn't be surprised to see Bitcoin head down towards the 80,000 level. We'll see. Those are my thoughts right now. Any questions you guys have for me? Any thoughts on, there's the bell ringing, so I got to get out of here. Any thoughts on private credit concerns ties to AI? Yeah, huge amounts of private. I'm concerned in a major way, and I've throughout the week been talking about this in our morning meeting. So you're getting a live look in on a Wednesday, and I do it every Wednesday for everybody. But if you'd like to be part of that conversation and understand how we're taking advantage of the private credit crisis, then you're going to want to be a subscriber. So ARMR report. Every morning meeting, you can join us, become an ARMR insider, trade with us all day on the desk. Go to armorinvesting.com and find out what is the right level for you. I'd love to work with you. Feel free to reach out. You can always give me a call if you want to chat about it as well. Everybody have a wonderful trading session. Thanks for spending time with me this morning. ARMR Insiders, we'll get the live trading desk started in a few minutes. I'll see you over there. Everyone, at the end of the day, think for yourself. Make your own decisions, risk tolerance and goals, and be the smart one.